channel. Without wasting our time, we'll start with finance, stock, and commodity market terminologies. First is agent. Who is agent? A brokerage firm is said to be an agent when it acts on behalf of the client in buying or purchasing of shares. When you trade, the person who helps you for buying or selling your security is agent. At no point of time in the entire transaction the agent will own the shares. He will act as agent only. So the ownership will get transferred from one person to another, but it will not get transferred in the name of agent. Who are the major agents? This is just example. I am not promoting anyone. Sher Khan, Motilal Oswal, Zerodha, ICICI Direct, IIFL, Angel Broking, Axis Security, Kotak Securities, Karvi, and HDFC Securities. Then we will move to next point, amortize. What do you mean by amortize? Amortization is gradually writing off the initial cost of asset over a period. Okay, we have studied the concept of depreciation. It is in similar line, but the basic difference between depreciation and amortization is for intangible asset, whereas depreciation is for tangible asset. Here, if we have taken one example in which we are saying that the cost of asset is 5 lakh rupees and it has to be amortized over 10 years. So in every year we will expense out 50,000 as a amortization expense. So next point is annuity. What is the meaning of annuity? Annuity is fixed sum of money paid to someone at each year, typically for the rest of their life. Okay, have we seen payment to LIC? People pay for LIC say for 25 years or something. So this is annuity. Annuity due, an annuity whose payments occur at the beginning of the each period. We have mutual funds, SIP, and all those. The only difference between SIP and this is paid for typically rest of their life. Okay, so it is for longer term. We can say period of 25 years, 30 years. That is annuity. Generally, in case of insurance, annuity is done. Next point is annuity. Oh, sorry, the same point. A series of payment of equal amount fixed at interval and specified number of period. Say the same concept. I have explained it again. So this is the annuity. So what is annuity? In 2017, I have deposited some money. In 2018, same amount. 19, same amount. A stream of payment made out of periodic basis. So that is my annuity. Next point is appreciation. Appreciation is increase in value. So if an asset you bought at 5 lakhs, now its value is 7 lakh. So it has been appreciated by rupees 2 lakh. That is my appreciation. Appreciation is increase in value. Simple appreciation is increase in value. Next point, arbitrage. So many people get confused what is arbitrage and how it works. So arbitrage is simultaneous purchase and sale. Simultaneous. So both transaction and happening, purchase and sale, both are happening of same commodity. Okay, identical commodities or instrument. The simultaneous sale or purchase is done in order to take advantage of the price variation in two different market. So purchasing and selling only at different market. So that is the basic difference. So that is my arbitrage. Okay, for example, purchase of gold in one nation and simultaneously selling it in another nation. Here I have taken one example. Say Citibank, at the start point it is having $5 million. So it gets it converted to yen. So that becomes 4.85 million. Then they get it converted to pound. Then it becomes 3.43 million, and again it get converted, the value becomes 5.025 million. So this is the gain. Say started with 5 million and ended with 5.025 million. So that is my arbitrage, buying at one market and selling it in another market, identical commodities or goods or instruments. Next concept is asset. Asset means an economic resource that expect to be a future benefit. Simple asset क्या, asset is expected to be a benefit in future. Asset means an economic resource that is expected to be of benefit in future. Probable future economic benefits obtained as a result of past transaction. Okay, so whatever my past transaction that is giving me future economic benefit is my asset. Land, building, car, anything, furniture, all these are my asset. Anything of a value which the firm has a legal right to claim. Owns, anything that firm owns having future economic benefit. Any owned tangible or intangible object having economic value or useful life or useful economic value useful to the owner, that is my asset. In other words, an asset may be a physical property such as building, or an object such as stock certificate, or maybe right such as right to use patented process. So that is my asset. Now we will see types of asset. Types of asset, first is current asset. So those asset which are expected to be get converted into cash within 12 months, say within a year, 12 months, within 12 months, then that is my current asset. Example, cash, marketable securities, accounts receivable, or inventory. So routine transaction, and it will generally get converted into cash within 12 months. Okay. Next is fixed asset. A fixed asset cannot be quickly turned into cash without interfering with the business operation. The valuable items last more than 1 year. So we know fixed asset comes land, building are the example of fixed asset. So if you have to interfere your routine business to get to interfere your routine business operation to convert your fixed asset into cash. Now example, land, building, machinery, vehicle, equipment, furniture, and long-term investment. Intangible asset. Intangible assets are the items such as patents, copyright, trademark, and other kind of rights and other things of value to the company, which are not physical object, or often they do not appear in the financial statement. Okay, intangible asset, only self-generated intangible asset like goodwill and all, these are not recorded until and unless it is purchased from somebody else. So only purchased assets are recorded in the books of account. Next point is ask oblique offer. So many people get confused what is ask or offer rate. So ask and offer are same. When somebody is asking you money for their shares, that is ask rate. When somebody is offering you, हम लोग डे टू डे लाइफ में पढ़ते हैं कि what is offer, what is not offer. So like in day to day life we get to know about यहाँ पे offer चल रहा है. So that is offer. Or ask is somebody is asking money to sell their shares. So don't get yourself confused. The lowest price at which the owner is willing to sell his securities. So he is asking for money or he is offering at. So generally people get confused. Ask means we are asking. No, he is asking for money. We are asking for goods. That is in financial terms we are asking securities. So ask and offer rate, these are same. It is bid price. It is related to ask oblique offer is the lowest price at which owner is willing to sell his securities. So don't get confused for this. So a price at which seller is willing to sell, and bid is the price at which buyer is willing to pay for the stock. So bid is different and ask and offer is different. Okay, ask and offer, always read it together so you will not get confused yourself. Next point, bad debts. Bad debts are the amounts owed to the company are not getting paid. So when you sell goods on credit, okay, so that party becomes your receivable, that is your debts, and that party that turns their in bad when they do not pay you. Okay, So you have to take a charge to the your financials in P&L, and you will expense out bad debts. There is always provision made in the books, like provision for bad debts, provision for bad and doubtful debts. An account receivable becomes a bad when it is recognized that it won't be getting paid. So if you are not getting your money back for your credit sales, then that becomes your bad debts. Sometimes bad debts are written off when recognized. Okay, so that means when you are not getting paid the money, you have to write it off the balance receivable, and you have to take the hit to your statement of profit and loss. The next concept is balance sheet. Balance sheet is a statement, you, as its name says, balance sheet. What is left over with you? So what is balance with you? That is your balance sheet. Balance sheet is a statement of financial position of the company at a single specific time. So generally we see that is 31st March. Many companies, some companies give quarterly results. So balance sheet is as on the last day of particular quarter or particular year or particular month. So when the business get closed for particular day, month, whatever it is, so whatever left over with you or whatever left over with the organization as on the date, that is your balance sheet. The balance sheet is normally list of all assets on the top and liabilities and capital listed down at bottom. If you see balance sheet, it is like this. Okay, here your CY, here your PY, here okay assets, then total of assets, then liabilities, total of liabilities, capital, total of capital, then total of liabilities and capital, and that should match with your asset. Next concept, bond. It is not Bond 007 James Bond. So bonds are, bond is a typical long-term promissory note. Promissory note means promise to promise to pay. Will not go in technical terms, we'll just understand the concept. Bonds can be either registered in the owner's name, okay, registered bond, or bearer instrument. So this can be traded. So whenever anybody holds that bond will get paid. So it is a written record of debt payable in future. So bonds are issued by corporates, government, anybody. So the bond shows the amount of debt, due date, and interest rate. So some bonds are valued at, some bonds are given at discounted rate. Say 100 rupees bond is being sold at 94 rupees for 1 year. So that discount becomes your interest portion. Okay, this is just to explain. This is a typical format I have copied from internet to explain how promissory note looks like. Then next concept, book value. Simple, a book value means whatever assets are there less liability. That is my book value. Okay, book value. How book value? So book value is asset recorded at books, liabilities recorded at books of account. So that is my book value. So book value means value of asset recorded at the company's book. Same thing I have explained you. Book value is often different from true value. How come it is not true value, book value? So in accounting concept we have studied historical cost method. Okay. So for a land you have purchased at 1 lakh rupees, now it is being valued at 20 lakh rupees. Okay, so book value may not be true value, correct? So now in Ind AS, okay, now new accounting standard, those ask you to report the fair value in notes so that users of the financial statement will understand what is my true value of this particular asset. So here it is 7, it may be more or it may be less. Break even point. So what is break even point? A break even point means a point where my expenses matches to my revenue. My revenue from sales is exactly equal to amount of expense. So if I sell worth rupees 10 lakh rupees, So my cost is also 10 lakh rupees. So now if I sell anything more, that will generate my profit. So break even point is where your cost equal to your revenue. Simple. That is your break even point. We'll see example. Break even is often expressed in number of units, so that amount must be sold produced. So in costing we generally see how many goods to be sold to earn to reach at break even and to reach at profitable positions. So we'll see one example here. The fixed cost is say 10 lakh rupees. So if I sell 1 unit, 10 unit, 100 unit, 1000 unit, okay, sell 50,000 rupees, 5 lakh rupees, and 50 lakh rupees. So a variable cost is always varies with the sales. Okay, correct. 49,000, 4 lakh 90,000, 49 lakhs. So contribution 1,000, 10,000, 1 lakh. So I have to sell 1,000 unit to reach at 10 lakh rupees. So that my fixed cost will cover. So anything sold above 1,000 units, above anything sold above 1000 units will generate profit for the organization. So break even point is 1000 units. Next is budget. Budget, we all know budget is the detailed plan of future, usually expressed in formal quantitative terms, that is in monetary terms. In simple language, budget is explained in monetary terms. Okay. It also a detailed plan of acquisition, use of financial and other resources over a specific period of time. So in whatever we do in budgeting, a general monthly budget we see as a home, we see my budget is rent is X amount, food is X amount, gas, entertainment, whatever. Actual we compare, and whatever difference we have to borrow or we have to break our investment, or if we have increased our earning, so that will get compensated. Now, next question is bears. So bear is market players are pessimist. The share price are expected to fall. So what is difference between bull and bear? Bear. Have you seen how bear works, or how bear like deals with the situation, difficult situation? If we trouble a bear, then he will kill us by pulling down. Okay, he pushing down. Sorry, he will push us down and he will kill us if we trouble him. If we trouble a bull, what he will do? He will push us with his all this what we can say, with his angry head. He will push. He will push us. So that is the difference. So in bearish market will fall. Okay, the bear will kill us by pushing down, and in bull market bull will push us to upside. So that is the basic difference in bull market and bear market. Hope base price. Next concept is base price. So what is base price? The price at the beginning of trading day. So that is simple base price. Okay. So any given working day, if the price of the stock, say particular stock, say Reliance Industry is 2200 at the beginning of the day, then that becomes base price for the day. Basket trading. basket Basket trading. So investor wants, so in basket trading what happens, investor does not deal in single security. Okay, it buys all 30 shares of Sensex or 50 shares of Nifty. Okay, everybody knows that Sensex is sensitivity index of 30 shares. Okay, and Nifty is sensitivity index of 50. Nifty 50. Okay, Sensex 30. So if one has an opinion that market will rise or market will fall, what he will do, he will make position, basket position, in which he will deal with all these securities which derives the market. So next important concept is Badla. What is Badla? Badla is, so in future of an option, say in future, what you do, you say that you don't want to settle your transaction, you have to carry it forward to next period, next settlement. So monthly expiry, you try to deal in next month. So monthly April, May, June. Okay. In April you say you don't want to settle your position, you want to settle it in May. So that becomes Badla. So what will happen? You carry forward your transaction from one settlement period to next settlement period. That is my Badla. Okay, carry forward is done, so you have to maintain margin. Okay, or if any interest charge, that has to be paid. So that concept in detail about Badla will understand in this video. This is basic concept video in which you understand whatever Badla is. Badla is to settle your open position in next period. That is your Badla. Blue chips. So blue chips are, what are the blue chips? Every day, now and then we listen, okay, you have to invest in blue chip stock, you have to invest in blue chip stock. So what are the blue chips stocks? Blue chips are the shares of large, well established and financially sound companies with impressive record earnings and dividend. So well established, those companies which are well established. So those are my blue chip stock. Okay, so in which, see, understand the concept, in whenever you invest in blue chip stock, it provide low to moderate current yield short term and moderate to high capital gain yield. Okay, so price will increase, price will increase, price will increase. Price volatility of such shares are moderate, not high, not low. So slowly, daily, moderately they will increase. What are the blue chip stock? Tata, TCS, ITC, Reliance, Infosys, SBI, HDFC. So only these are the blue chip stocks? No, these are just examples. Okay, there are many blue chip stock. You can go and search on web. You will get a list of blue chip stocks. Beta, beta. So what is beta? Beta is sensitive. Okay, how your stock is sensitive or responsive to the market change. Okay, if there is 1 rupee change in market, how much you how much change there will be in your stock. So that can be more than one or more less than one. Okay, high beta means risky stock, low beta means moderate or low risk or minimal risk. Okay, so if market increases by 100 points, okay, then how your stock will respond to that? So we'll see the definition. It is a measurement of relationship between stock price of any particular stock and the movement of whole market. Correct, that is my beta measures the responsive of stock price and change to overall. So if there is 1% change in market, what percent my stock will change? In percentage form we have to see that. So if market is up by 5% and your stock is up by 7%, then beta is more than 1. Okay, beta is more than 1, so it is a risky stock, you can say. If beta is lower than 1, then that is low risk. Okay, so if there is a change in market by 5% and your stock moves by 3%, that is low beta. Bull market, we have seen bull market is where you expect your prices will increase consistently. That is bull market. Bullish, so how bull reacts to human being, or when we trouble him, he will push us upside. Okay, so that is the bull market logic behind this. Business day, what is my business day? The day on which stock market are open. Okay, which are those day? Monday to Friday, correct, excluding public holiday. That is my business day. Next point is demand by a group. Sorry, call. So what is call? it is not call option. Don't compare it with call option. Okay, it is not call option, it is call. So call is demand by a issuer of shares for payment. Okay, when partly paid shares are there, when company calls for money, that is my call. Okay, we have seen recently Reliance Industries came up with partly paid shares. Reliance PP, Reliance Reliance PP, RILPP. So in which what Reliance PP is doing or Reliance Industry is doing, it is asking for 25%, 25%, 25%, 25% in 4 installment. So this calling for money, if you are allotted a right share or something, then company is asking for this money, that is call. Bid and offer. Bid. Okay, so we have seen bid and offer, ask and offer together. Now we are seeing bid and offer. Bid is at price at market maker buys from the investor. Offer is price at which he offers to the stock to investor. Okay, who are market makers? Market makers are also investors. Okay, so the market makers are high volume traders. Okay, high volume traders. Market are market make. So bid is buy, offer is sell. Simple. This is what we have to understand from this concept. Bonus is what? Bonus is allotment of shares without asking for money. So how it happens? Wherever there are reserves that has to be converted into capital, the company issues bonus shares. So how it helps? So does it change the valuation of company? No, just reserve get converted into equity. Okay. And how it helps investor? What will happen if investor is having 100 shares, then he may get say 10 shares. So now he is owner of 100 and shares, 10 shares. However, the value of share, book value of the share does not change. But however, whenever the company issues a bonus shares, that has a bullish impact on market sentiment and the causes share in price. See what happens. Simple, simple. When a company is having reserves, okay, company is having reserves, so what will they do? Either they will give a dividend, so the company will give dividend, so cash will go out, or they are giving bonus shares, so cash will remain with company. So when company gives dividend and when company holds cash, so when company gives dividend, that means company is not having opportunity to invest or take that money's benefit. When bonus shares are given, that time company feels that if company keeps that money, that will do a better business and that will give a better opportunity to the company to earn more, so company issues bonus shares. Book closure. Dates between the company keeps a register of members closed for updating a prior period, updating prior to the payment of dividend and issue of new shares and debentures. So whenever dividends are declared, so there should be a cutoff date. That cutoff date, say if you are holding on the 10th or some example, on that day, then you are eligible to get bonus, else the person whose name is reflecting on 10th will be getting the bonus. So that is my book closure. Next, brokerage. Brokerage is commission charged by broker. Simple. SEBI guide determines the maximum amount of brokerage in case of all securities, dealing with all equity and as well as debt securities. Buyer. A trading member who placed the order for purchase of securities. Buyer. Call option. So that time we have discussed about call, so not to get confused with call and call option. Call option is right to buy. Right to buy. That is my call option. So right, it is right, okay, not obligation. So what happens? What is called? Say there are three types: in the money, out of the money, at the money. There are three kind of options. So say I'm giving you example as if you are not aware of any basic concept. So say 100 rupees price is of ITC share, 100 rupees price. Okay, you have call option of buying it at 95 rupees. Okay, you have bought it at 3 rupees. So if the share price is above 95, you are in the money. Okay, but you have paid 3 rupees charges, so 98 will be your break even cost. So it is now 100, so you are in profit of 2 rupees. But if it falls in at 90, do you have obligation to buy at 95? No, you don't have any obligation. In this case, what you will do, you will lapse your call, so you will not go for it. Okay, but however, if share prices turns to be 105, then what will you do? You will buy. You will exercise your right to buy. So you will be buying at 95 rupees plus 3 rupees your call option cost 98, and you will be selling it at 105. So 7 rupees per share you will be earning. That simple. I'm giving you a rough example. Close price, the price at which stock is traded at given. So whatever the close price, so everybody knows the final price at which stock is traded on the given particular trading day. At 3:30 around, the stock is traded at 111. So that is close price. Capital budgeting, the process of planning expenditure on asset whose cash flows are expected to be extend beyond the year. Okay, capital budgeting, when you are buying an asset, say a machinery, what you will see, you will say you are spending say 10 lakh rupees. Okay, if you are spending 10 lakh rupees, so you expect in 1 year, 2 year, 3 year, 4 year, 5 years, you will produce 1000 unit, 1500 units or something, and how much you return you will get. Say you will be getting, say at the end of year, 14 lakh rupees. So what you will do, you will discount it and you will compare it with your current cash flow. How you will discount it? The cost of borrowing or whatever rate of interest you want, expected rate of return, that you will take and you will discount it. If it is above 10 lakh rupees, then you will go for that option. That is your capital budgeting. Capital gain yield, the capital gain during the year divided by the beginning price. So that is capital gain yield. Next, capital market, the financial market for stock or for intermediate for long term debt. Stock is equity and debt. Only two kinds of instruments are there majorly. Either they are in form of equity. Somebody will say, is there any market for preference shares? Say broadly we will classify owners fund or borrowed fund. So equity is owners fund and debts are borrowed fund. So only two kinds of market. So capital markets deal with uh, equity and debt. Cash budget, a table shows cash flow, receipt, disbursement, cash balances of the firm over a specified period. So cash budget is there. Credit period, the length of time for which credit is granted, say 30 days, 90 days, etc. Closing price, so that we have discussed already, may be repeated at the cost of repetition. We will go ahead. The trade price of security at the end of trading day. Commercial paper. Commercial paper are also promissory notes of large firms, usually issued in denomination of 1 lakh or more, having interest rate somehow somewhat below the prime of lending rate or commercial bank rate. Oh, you understood that the interest rate are below the prime of below the interest rate are below prime of lending rate of commercial bank, correct? So it is below the lending rate of commercial bank. Commodities. Commodities means product used for commerce that are traded on separate authorized commodities platform. Commodities include agriculture products as well as natural resources. So we soya seed, all pulses, then copper, steel, all metals, etc. etc. Convertible securities, a security, bonds, debentures. Convertible securities, a security, bond, debenture, preference stock by an issuer that can be converted into other securities of the issuer as are known as convertible securities. So if a company issues a bond and after 10 years it will get converted into equity, that will become a convertible security. Consolidation, business combination of two or more entity that occurs when entities transfer all their net asset to a new entity created for that particular purpose. That becomes consolidation. Creditor, these are the people organization you owe money. So if you have bought a goods on credit, so the person from you whom you have bought the goods are your creditor. So we have bought goods worth rupees 10 crores from Mr. X. So Mr. X is our creditor. Debenture, a type of debt instrument that is not secured by physical asset or collateral. Debentures are backed only by general creditworthiness and reputation of the issuer. So just note here, so it is not collateralized by any other security or any other thing. Debentures are floated in the market or traded in the market based on creditworthiness of or reputation of the issuer. Debtor. Although debtors are considered as an asset, if you owed a vast amount, that might become indicate a problem in collecting monies owed and possible cash flows difficulty. So debtors are if you have sold goods on credit, sold, okay, so that party becomes your debtor. And if there is huge debtor balance, huge heavy, that means you are not able to collect your money from debtors. So that is your bad point. Defensive stock, a stock that provides constant dividends and stable earning even in the market period where economy is in downturn. Okay, in even in extreme critical situation of stock market, these companies continue to pay dividend at constant. So those are defensive stock. Next point is depreciation. Depreciation is the way we have seen depreciation and amortization. Okay, so depreciation and amortization is same. Depreciation is done on tangible asset and amortization is done on intangible asset. So we'll move to next point, derivative. Derivative, a security whose price is derived from one or more underlying asset, that is derivative. Okay. In case of future options, the prices of underlying stocks price changes, then value of future and option changes. So that is derivative. So value is derived from one or more underlying asset. Diversification, reduction in investment risk by purchasing shares of different, okay, DIFFERENT companies operating in different sectors. Dividend, a portion of company's earning decided to pay to the shareholders in turn of their investment, that is dividend. So if you are receiving money on your equity, that is your dividend. Equity, the capital supplied by common stockholder, that is equity. So owner's fund is equity. So when you invest in company, then you become part of equity. Exchange rate, the number of units given currency. Exchange rate, okay, 170 rupees equal to $1. That is my exchange rate. Simple example. Face value, cash denomination, or the amount of money the holder of individual security going to earn from the issuer of security at the time of maturity, that is face value. Correct. So face value is 2 rupees, but market price may be 200 rupees. So that is there. Financial instrument, a financial instrument is anything that ranges from cash, deed, negotiable instrument, or any other matter, written or authenticated evidence that shows existence of transactions and agreement. Financial intermediary. A financial intermediary basically a party or a person who acts link between a provider and the user. Okay, so security, share broker, banks are the best example of financial intermediaries. Correct? Issuer and user, the person who connects issuer and user is financial intermediary. Government bond, which is also known as government security, is basically any security that is held with government and has highest possible rate of interest. Hedge is a strategy that is used to minimize the risk of particular investment and maximize the return of investment. So hedging is done to minimize the risk and maximize the return.